Hi there, my name is Shaun Humphries. Welcome to the presentation Planning for Retirement, How to Avoid the 7 Major Pitfalls. I've had the privilege of working with clients over almost a 30-year period and helping them to prepare for retirement, to transition into retirement, and to be retired. And over that time period, I've seen clients who've done this really, really well. The transition's gone wonderfully. They have confidence and peace of mind around their planning. And just overall, the plan seems to have worked well. I've had other families where there's been struggles along the way, and maybe the planning didn't go as well as they had hoped. And when I reflected on all these case studies, literally hundreds of families, I found that there were 7 major themes or pitfalls that could easily get in the way of people planning effectively for retirement or having additional anxiety or concerns in their retirement years that really got in the way of them enjoying retirement the way they'd hoped they would enjoy it. So these major pitfalls are critically important to keep in mind as you plan for retirement, but they're also pitfalls that can emerge even when you're retired. I don't think they ever completely go away. They're ongoing issues that need to be dealt with on a regular basis, and I really do think that one of the major roles that financial advisors or wealth planners play is to help clients stay on track and to deal effectively with these major pitfalls. So we'll talk about those pitfalls in the context of this presentation. There might be other pitfalls that you'll think about, but these are the major ones that, as I reflected on almost 30 years of experience, that came to mind for me. Now, first of all, I want to talk about why this topic is so important. When you think about it, retirement is one of the biggest transitions we go through. Others that we think about would be graduations and starting a new career or job. It could be finding a partner, getting married, then starting a family. There's all kinds of transitions that go on. And then there's transitions like retirement. It's a big one, and it has huge impacts, not just financially. That's usually what we think about when we think about retirement, but it has social impacts, emotional, psychological impacts, and even physical impacts. What's interesting about retirement planning is that when pollsters really ask questions of individuals around different aspects that create anxiety or concern for them, retirement is one of those areas. It should be a time of planning for the next great adventure in our lives, more flexibility, maybe putting our time into things that we would like to put more time into that we didn't have a chance to do when we were raising our families or pursuing our careers. And yet there's a lot of anxiety around the area. Last year actually, October 2014, the Toronto Star ran a headline saying Canadians worry about saving enough for retirement. And in the study or survey that they quoted, respondents to that survey said that 40% of them said they had no idea how much money they needed to save for retirement. So no wonder people are anxious. So they had no clarity on what they needed to set aside to achieve their retirement objectives. Added to this fact is that we live in a world of hyperchange. So I'm not telling you anything new there, whether it's political change, massive global economic changes. We see globalization, professions and jobs in North America that we would never have believed would be competing against lower cost providers in emerging market economies are taking place, whether it's computer technology, white collar professionals. There's even medical tourism going on. So we're seeing these major changes, and that means that the ability for governments to protect tax revenues, for organizations and companies to have the same revenues to provide pensions and benefits, I think will be compromised. I think there'll be really big challenges in this area. So the more that we can do to plan intentionally in this area, the better we will be able to weather these changes, these major forces that are going on around us. And one of the big forces that is a backstory to this presentation is an aging demographic. In Canada, we certainly have an aging population. Back in 1971, the cohort or group of 65 years of age plus was just under 8% of the overall population. By 2011, it had increased to 14.4%, just under 15%. And then by the 2051, demographic specialists are forecasting that we'll be at almost 25% of the population will be 65 plus. So again, this has big implications. It has implications on pension plans. Will employers and governments be able to have the capacity to keep paying benefits the way they have? It'll have an impact on the healthcare system as well. And unless we get really creative, this aging demographic could potentially have an impact that will erode our standard of living as more and more tax revenues need to go in the direction of pensions and health care. That tide could be turned a little bit if we become more creative in our immigration policies, more creative on what retirement looks like, what that transition looks like. I think by necessity, people will be retiring later. They'll be working longer. There'll be more flex time to accommodate those kinds of arrangements. I remember when I was first in the industry, there was a life and health insurance company that ran a whole series of commercials called Freedom 55. Now, in a whole bunch of reasons, I don't think retiring into a life of leisure at age 55 is a good thing. I think that's a negative thing. But having the option to be retired, to put more time into hobbies, interests, volunteerism, starting a new career, doing things that you didn't have time to do in your previous life, I think those are good things. But the reality is Freedom 55 for most of us, most people out there, and most of the clients that I dealt with, was not really a reality. It often looked like a transition to retirement. So they might have retired at age 55 or 58. They might have worked for a few years, and then full retirement would often begin between age 60 and 65. So this demographic story is significant, and we need to be mindful of its impacts long-term to our planning. So the first pitfall that I want to talk about is the pitfall of not cultivating emotional resilience. I have in front of you here an image of a brain, but you see that little almond-shaped red dot in the middle of that image, and that's the image of an amygdala. The amygdala is a little organ in our brain that really attunes us to danger. It works really well in the context of running from the lion or fighting the lion. But it doesn't work quite as well in the context of our modern society. When you think about it, we have information overload. We're getting fed information at unprecedented levels. And that information is becoming, to a greater extent, more and more sensational. And the reason is that the producers of information have to get our attention. What we know is that good news does not stimulate attentive behaviors. It doesn't really catch the attention of the amygdala to get us ready for danger. But it does pay attention to negative news. And so whether it's newsprint, the internet, TV, radio, it doesn't matter what kind of medium you're talking about, they're going to use a negative news slant to get your attention. And in a 1,000-channel universe and the internet, this information is coming at us all the time, and we're integrating through smartphone technology and other technologies exposure to this information on almost an hour-by-hour, moment-by-moment basis. What we fail to realize is that, and I think at some level we get this, but I think most of us consciously fail to realize that as we feed all this negative information into our lives without censoring it, without questioning it, without being a little attentive in terms of what we allow to leak into our minds, it can have a negative effect because the amygdala doesn't differentiate between real dangers and fears and perceived or non-real. And so you can get some information that creates anxiety. It may not be a real danger or fear, but your amygdala does not differentiate between this news headline that you're reading or hearing about and its application to your day-to-day life. And as a result, a lot of people are walking through their lives experiencing low-grade anxiety. They're just not feeling at the top of their game. And that's a significant issue because if we're feeling low-grade anxiety, it begins to compromise our abilities in other areas, and particularly in the area of retirement income planning, it impacts our cognition, our ability to make good decisions. So as your anxiety goes up, as the stress response begins to kick in, you begin to see a narrowing of your focus. Our cognitive abilities become somewhat compromised. And so that when you look at information, rather than looking at the grand sweep of information, all the factors before you take action, you're beginning to narrow your focus and just focusing on the negative aspects of the news. And what that causes often, more often than not, is knee-jerk decision-making, or it causes no decisions to be made, which sometimes is not the best option either. And so my recommendation to you in this area is to try to cultivate emotional resilience, and you do that by taking captive control of the information that you're allowing to come into your life. And so it could be as simple as having news fasts. It could be as simple as monitoring the kind of information that you're taking into the day. It could even be intentional around consuming good information, encouraging information, uplifting information. I had an experience with my father-in-law a few years ago where I'd come for a trip, our family would visit, and he would be a little bit agitated about all the negative news that was out there. It just seemed like the world was just a terrible, terrible place. And I'm the first to admit that there's lots of negative things going on, no doubt. But it's not all negative. And what was happening is he was, as a retiree, he was spending a lot of time, watching the news, and it was a constant consuming of news. He was consuming newspapers, and of course he was just filling his mind full of all this negative news. And he wasn't getting a regular counterbalance to maybe some of the good things that were happening out there. So that's pitfall number one. Become aware of the information you're consuming. Become aware of low-grade anxiety and the stress response that it might be triggering. And begin to cultivate habits in your life that counterbalance that. So here's one practical tip. Peter Diamandis and Stephen Kotler wrote a book a few years ago called Abundance. The Future is Better Than You Think. It's a great book. And the biggest takeaway that I want to share with you on this book is that it's a great counterbalance to all the negative news. Peter and Stephen, talk about the fact that, if we look at just something as simple as infant mortality, it's decreased by, 90%, over this last century. Mortality, maternal mortality is decreased by 99%. And the human lifespan over that time period is increased by more than 100%. So we've seen some incredible changes and some good news in that area. When you think of the stats, the World Bank came out with some information that the number of people living on less than $1 a day is more than halved since the 1950s to below 18% of the world's population. So yes, we still have billions of people who live in backbreaking destitution and poverty. There's no doubt about that. But we've made very, very significant improvements in that area. At the current rate of decline, the number of people in the world living in absolute poverty will hit theoretically zero by the year 2035. If you look at the differences around the world, even around energy, we're so reliant on non-renewable sources of energy. Diamandis in the book talks about the fact that the sun blasts 5 times more energy every day than the planet uses for a whole year. And we're seeing very, very quickly the development of new technologies that will capture and are capturing the energy from the sun more and more effectively all the time. So step number one, if you're looking for a book that could be a source of encouragement in this vitally important area, I'd encourage you to pick up the book Abundance. Pitfall number two is we're often not respectful of transitions in our life. And so when I talk about transitions, this is really has to do with the emotional and psychological aspects of going through transition. And there's no doubt that, like I said, retirement's a big one. And there's always an aspect when we go through transitions of the ending or losing or letting go. And for some people, retirement is a losing. They're not quite ready for this transition. Most of their meaning and their social network and their purpose and sense of significance really flowed out of this experience that they were having prior to retirement. And it's not unusual, even for those of us who do a very good job of planning for this transition, to go through a bit of a neutral zone. The one thing that I hear clients say all the time is, for the first little while it didn't seem real. It just felt like I was on an extended holiday. So it does take a while for us to transition emotionally and psychologically to the point where we actually now are retired. We're going through this transition. We've left something. We're kind of beginning to settle through something new. It's not quite something we're used to. There's new patterns, behaviors, relationships, all kinds of practical things we have to get our head wrapped around as we go through this transition. And then there's a new beginning. And for many retirees, that new beginning never really happens all that effectively because they have not intentionally planned for it. It's not something that just happens. You need to dream and plan and be very intentional around what this new beginning is going to look like. So we have the letting go, the ending of one part of our life, the neutral zone, transition to something different, but it creates anxiety and concern, but also hopes and expectations. And then we transition to the new beginning. So there's some very important things we need to be mindful of in this area. We need to think about retirement as a whole person exercise. I deal with the financial aspects with my clients, but what I've come to recognize that there are other aspects. So again, I've alluded to the fact that social, work, and our patterns before retirement have a social dimension. That's a very important aspect of health. Intellectual, we need to find ways, if we're engaged intellectually in our job, what can we do to maintain that part of our world? Healthy aging and retirement is around maintaining those intellectual capabilities. Vocational, you get a lot of meaning from that vocational pursuits. Maybe you'll work part-time when you go through retirement. Maybe it's not a direct, abrupt retirement. Maybe there's ways that you can use your skills and abilities through volunteerism. Emotional, again, we get a lot of satisfaction through our vocational pursuits. There are emotional aspects to work. There's a sense of achievement and doing a good job and getting pats on the back that may not be there when you retire. And there's a physical. The physical is something we need to be mindful all the time. And certainly as you retire and transition into that world, you always have to be intentional around the physical aspects. And you know the areas, but it's diet, obviously, and physical activity and managing stress. And then the spiritual. And spiritual does have a connotation that includes great purposes. How are you going to drive purpose and meaning in your life when maybe you were getting a lot of that from the pursuits that you were engaged in before retirement? You need to be intentional around what that'll look like after you're retired. So think of this transition as a whole person experience. And the clients that I've seen make this transition the most successfully have focused in on each of these areas. And we've had conversations about them, they've embraced them, and they've become very intentional in how they're going to deal with each aspect. A great book on transitions is by William Bridges, Transitions, Making Sense of Life's Changes. I'd highly recommend it as a really good primer for thinking about the different aspects of transitions, and it's particularly helpful when you think about the transition through to retirement. Pitfall number 3, they don't know their numbers. And this really gets back to that Toronto Star study that I quoted, the article in the Toronto Star saying that fully 40% of people had no idea how much money they needed when they retired. And so quite simply, knowing your numbers is, answering basic questions like, how much after-tax income will you need when you retire? What rate of return do you need to aspire to fund your retirement objectives? What after-tax income will basic forms of pension that you're accruing generate for you? And what amount do you have to pull from other assets or savings to supplement your cash flow? What assumptions are you going to be using around longevity and life expectancy? What about inflation? That's a reality. What inflation rate do you want to build into that retirement plan? So these are just some of the questions that you need to be asking and getting answers to. And for some of you, you're analytically bent and you're more than capable of running through the numbers and solving some of those on your own. But what I found with most of my clients is that they didn't really know where to start. They had some hunches and some ideas on each of those, but they really relied on us to crunch the numbers, to bring all the pieces together so that those questions could be answered. But what's interesting is I have clients who are very capable in this area. But what they were looking for was a little bit of peace of mind, sober second thought, someone to look at the numbers and to confirm that the numbers they had arrived at were on track. And so they found that to be an extremely helpful peace of mind exercise. So pitfall number 3, they didn't know the numbers, and that's something you need to get clarity on. Pitfall number 4 is they don't have a plan. And this one really ties into the previous point. So one of the ways you get clarity on your numbers is to have a plan. And that plan is designed to basically bring together all the aspects of your overall retirement planning. That's not just the hard numbers around how much capital you need and what your pensions will generate and what the tax impacts are going to be of those and the returns that you need. But there's other aspects that come into that. There might be aspects around estate planning. Your retirement plan is impacting your estate plan. What are your goals around that? I have some clients who go, you know what, my estate plan for my kids was to give away some of my estate so they could be set up, educated, help them with a down payment on a house. Once those things are done and my children are launched, I have no desire to have an estate that goes to them. I have other clients that do have estate planning ambitions and legacy ambitions, and that needs to be worked into their financial planning. There could be issues around long-term care and how they want to handle that. healthcare directives. So there's a whole bunch of areas that tie into the overall plan. You need to have a plan. The plan helps to give you a broad sort of picture of how things are working out. Specific action steps will flow out of that plan, and the plan needs to be updated on a regular basis to keep you on track. We use something called a financial roadmap. It's a great exercise to go through, where we identify personal milestones for clients, their major goals and objectives. We talk about the risks along their journey to their financial goals, and of course there are risks, right? There's sudden unemployment, there's economic downturns, there's market downturns, there's surprise illnesses that can come up. There's all kinds of risks that are out there that we have to deal with. And at the end of this roadmap, you get to what's really important to you. And ultimately, we save and invest, we build financial wealth because of other priorities. It could be maintaining a standard of living, having the option to be independent and flexible, pursuing hobbies, lifestyle ambitions, helping the kids, helping the community. It's different for each one of us. But the basic operating question around this financial roadmap is, what's important about money to you? What ultimately do you want your money to do for you and the people around you and in your world? It's a great exercise to go through. This is an example of what I'm talking about. This is a situation where we had some clients, John and Elizabeth, who were getting ready to retire. They're about 5 years away from retirement. They wanted to have about $60,000 of after-tax income per year, inflation adjusted, when they retired. They had about a 5-year window to work with. And when we first looked at their situation and discussed the assumptions, we found that they had sufficient capital to last to about John's age 79, 80. So when you look at this chart, the yellow and brown bars are incomes being generated from various sources of investment income and pensions. And then any shortfalls were being looked after from investment income or assets that they were depleting. That's the green. And you can see that for the most part, the majority of that green is fully used up by John's age 79. So that wasn't really a satisfactory outcome for John. He came from a family of long life expectancy. He didn't like the look of that drop-off. Wasn't prepared to reduce his lifestyle costs. So we came up with a bit of a compromise. We looked at increasing his savings by another $6,000 per year. And we felt that we could introduce some strategies into the planning that had the potential of increasing his long-term returns by 0.75%, 75 basis points per year. So when we did that and reran the numbers, we found that we could extend the life expectancy of his portfolio, that's in the green, out to his late 80s. A much more satisfactory result. The assumptions that we used were conservative, and now John had a track to run on. It provided a huge amount of confidence and peace of mind, and so every year we'll update this to make sure we're tracking in the right direction, and of course we'll course adjust as we need to. So this is part of retirement planning. Have a plan in place, and then updating the plan, and this kind of planning will provide a great source of confidence and peace of mind. Pitfall number 5, they don't stay engaged in the process. And really what I'm talking about here is the fact that there'll be a catalyst. Many people will come into my office and they're motivated to do some planning in this area. And so they get really engaged and they gather the information, they talk about their goals, we walk them through a financial roadmap, and we begin the planning process. And so that's all great. But what happens sometimes is life just gets busy, and once we do the initial planning, it's really, really critical that we have ongoing conversations about whether we're tracking in the right direction. So one of the pitfalls that people fall into is they do the initial plan, but they allow too much time to go by before they update that plan and course adjust. That's not just important up to retirement, but it's critically important this gets done each year as someone's retired. So we have to look at their portfolio. Did we get the returns that we needed? How much capital did we draw down on as opposed to the plan? Do we need to make adjustments? This is a regular conversation, and you can't afford to revisit it every 3 to 5 years. It needs to be an annual, sometimes even more often than that kind of conversation to make sure you stay on track. So you need to stay engaged. It's not a once in a lifetime conversation or once every 3 to 5 years. It needs to be at least yearly, particularly when you're retired, but even planning up to retirement. Number 6, pitfall number 6 is they don't embrace financial literacy. I think this is a critical area. I don't expect my clients to become, experts in this area. That's why they're dealing with me. So there's a certain amount of offloading or delegation that they want to do. But there's no doubt that the amount of financial literacy that somebody has will improve their ability to make good, sound financial decisions. The lower the knowledge level, the more that you'll see knee-jerk reactions, poor decisions, low probability decisions get made, because now they're allowing, again, that amygdala, a lack of information, a lack of knowledge, creates more emotion, more anxiety, less peace of mind. It, like I said before in that discussion on anxiety, it narrows our focus, it narrows the range of options we're going to look at, and will make poor quality decisions. So I always say to my clients, I'm not expecting to become an expert, but there's some basic concepts you need to be aware of, so that when I make recommendations or maybe sometimes surprises happen, it's not going to throw you for a loop. You're still going to be confident because you understand the context and the right high probability to decision to make in this area. So basic knowledge level around financial literacy, I know it's something that we're really committed to as a financial planning practice and the branch that I'm associated with. We run regular client events to make sure that the knowledge level that our clients have is improved and they have a chance to ask questions that hopefully will improve their knowledge level and peace of mind in this area. One of the things I'll talk about, and this is just one concept among many that are out there, but this is consistent with the idea of people not embracing financial literacy. And what I have in front of you is some information, and really what it's doing is these three bars represent the cumulative return of an investment, a dollar worth of investment invested back in January of 1970, and we allowed that investment plus its earnings to accrue to June 2012. The investment on the left, the red, is $1 invested in the TSX, the Toronto Stock Exchange, and we've reinvested all dividends, and that dollar basically grew to just over $42 over that time frame. We then have another investment, which is the green, which is the person just simply left the money in a cash account, and that cash account grew to just over $15, almost $16, and then we have the middle column, which I'll talk about in a second. So when we talk about financial literacy, one of these areas is this notion of market timing. So I can't turn on the TV or listen to the news without hearing some pundit who is talking about where oil prices are going or gold prices are going, whether the market's going to be high or low this year, when the reality is the ability to forecast these broad market changes or commodity changes is very, very difficult in the short term. And this particular chart sort of underscores just how difficult it really is to get this one right. Now, the middle bar is a bar that represents this notion of market timing. It's quite striking, this information. So we have on the left-hand side the one investor who simply just put the money in the TSX and let it run for that time period. That's 510 months in total. We then have the green bar, which is someone just left the money in cash, and then we have the middle bar, which is this individual tried to time the market. So we have 510 months of market activity from January 1970 to June 2012. And what's interesting, if you and I miss the best 9 months over that 510-month period, that's 9 months or 1.7%, our returns actually would be less than what we would have received had we just left the money in a cash account, a bank account. Extraordinary. Now, you might be thinking to yourself, well, you know, I'm an astute investor. I'm sure that I could figure out when the good markets are going to happen and when the bad markets are going to happen. There's this notion that we can, get bull market returns without having to go through the pain of bear markets. But this information, I think, points in a different direction. What's the probability that you're actually going to build a time when the 9 best months are going to happen? So 9 months out of a 510 month period basically generated the lion's share of returns over that time period. It's extraordinary. It's so concentrated as a time frame. It's one of the reasons why a lot of investment managers will say to you, listen, if you're going to be in the market, if you need stock or growth investments in your portfolio, that's the first decision you need to have a conclusion on. The second thing is you need to be committed to be fully invested in that portfolio. Now, that doesn't mean that you're not going to pull profits along the way, make some fine-tuning adjustments. But the decision about whether you're going to be in the market or not in the market is not a decision that you should be making. You're going to be in the market if you're an equity investor. Yes, you might be taking profits along the way. Yes, you might be making some minor adjustments. But principally, you're going to be in the market. one of the great challenges about trying to market time is that, number one, when you do decide to leave the market, the second question is you have to make a decision to go back in the market, right? That's the assumption. I'm going to miss the bear market, get the bull market. But of course, when we look back historically, a lot of these bull market returns, the good market returns, will take place right at the point of maximum pessimism. It's often the last time that you would think the markets would begin to rally. There's no proofs out there that would lead you to believe the market would rally. And the other thing is, once the market does begin to rally, you don't know whether it's a real sustained rally or whether it's just going to be a short-term run and there'll be another correction. So anytime someone leaves the market, they need an awful lot of good news before they jump back in. And because of that, they'll miss a lot of the initial bursts of a market rally that generate the majority of the returns over that economic cycle. So that's one concept among many that when we're sitting down with clients and trying to explain to them high probability decisions, this is a very important one. If you need money in the stock market or growth investments, okay, do you? That's the first decision. If you do, get the notion of market timing out of your head. Now, there's ways that we can deal with managing risk in the markets, and that's another discussion entirely, but for the most part, you're going to be fully invested. There's no long-term win in trying to time the market. Yes, it'd be wonderful to be able to get bull market returns without having to experience a bear market, but that's not how it works. So you have to be disciplined, and you have to understand that the high probability decision is to be fully invested. I think this chart really underscores the value to that particular strategy. Okay, so that's don't embrace financial literacy. It's a really important one. So number 7 is the individual don't hire a financial coach. So this might sound a little bit self-serving, but the reality is that for most clients and most individuals, we have a great ability to rationalize away problems and issues. So we get the notion that having a coach in sports or athletics makes sense. We've even heard that executives have coaches, that kind of makes sense. But this idea of having a money coach seems foreign to a lot of people. And yet, I would think, and I'll show you in a minute here, that having a financial coach is probably one of the biggest predictors of financial success, not just for retirement planning, but for overall wealth planning. And so let me just take a look at a study just to give you some background to that comment. So we had Ipsos Reid do a study, and there's been other studies in the United States that confirm the same kind of general trends in the data. And so the blue bars represent advised households. They have an advisor. The red represent households with no advisor. And all we're looking at here is the investable assets of these two major groups. And you can see that every age group, the level of investable assets is easily 3 or 4 times that of people who have no advisors, households that are non-advised. And there's a lot of different reasons for this. Now, first of all, I'd like to say that one of the reasons these households do so well is that they're getting great advice. There's some great strategizing. There's some insights the advisors are providing that are just invaluable. And, I think there's some truth to all those. But what these studies confirm time and time again, that the major factor that's driving this overachievement, both on financial assets, taking advantage of strategies, peace of mind, and confidence, the major driver is behavioral coaching. Yes, behavioral coaching. In other words, when the market goes down by 10 or 15%, it's, every fiber of our being wants to take action. We're now in fear mode. We're in self-protection mode. We're in conservation mode. And so that's why you see in the markets huge outflows of capital as the market's going down. And that's because that fear response is kicking in. You don't see the same kind of response with advised households because the advisor in that moment plays a very important role. There's sort of like this firewall between what the client wants to do but what they should do in that moment. Even the notion of being accountable. So your advisor provides a plan, they have an action plan, and then when you review things with your advisor, they're going to ask questions about, did you act on the plan? Are we tracking in the right direction? And all of us know that when we're accountable to somebody else, we're going to be more action oriented. We're going to probably act on those things. Maybe not all of it, but most of it, and we'll be tracking in the right direction. And then another thing is that we understand that we're not always great at self-diagnosing. We rationalize away problems. So we understand that in the healthcare field, a medical doctor would never do their own diagnosis. Why do we feel that we can do our own diagnosis effectively in our own financial lives? And so advised households understand that the advisor can be more objective and help guide them to better decisions because they're not as emotionally attached, or there aren't psychological blind spots that keep them from making great decisions. So again, this is a really critical area. I know it sounds self-serving, but there's many studies that confirm this. So you might be very much a self-directed individual. You don't like taking advice, but I think it's important to build a team around you of coaches, and one area is this area. I've got clients who are very astute business owners, very sophisticated financially. I've sometimes asked myself the question, why are they dealing with me? I'm not sure that they really need my expertise. But what they tell me is, Shaun, you're a sober second thought. You're another set of eyes. You can be more objective than I can. Sometimes I get busy and I don't act on the things that I should act on. And so you come into my life every once in a while to remind me of the things that I should be doing. So those are the major pitfalls. Like I said, it's not all of them, but it's most of them. And if you can address these pitfalls, you'll experience confidence and peace of mind. And let me tell you that these pitfalls are not sort of one-time discussions. These issues come into our financial lives and retirement planning on an ongoing basis. So it's not like you don't have them or you deal with them and they don't come back. Whether it's being resilient emotionally and psychologically, whether it's updating your plan, staying engaged, acting on the recommendations, knowing your numbers. These are all things that need to be looked at on a regular basis. And so when you look at your own retirement income planning, take a look at it. Are you dealing with these pitfalls? If you are, great. Give yourself a silver star. If you're not, then begin building in a plan to do that. Hope you enjoyed the presentation. If we've piqued your interest about retirement income planning, we'd love to have a conversation with you. Feel free to visit our website at www.shaunhumphries.com. We've got all kinds of video resources, white papers. Check out our financial planning, retirement planning process called Game Plan. We have a description of that process, a little short video on how it works. And if you want to follow up and have a conversation on that, we would welcome that conversation. So all the best with your retirement income planning.